Denmark's economy in the second quarter showed a productive stance characterized by steady output, very low unemployment, contained inflation, pragmatic interest rate adjustments and a modest public debt burden, together composing a Q2 story of balanced expansion rather than overheated growth. Full-year GDP growth picked up to about 3.6% in 2024, and on an annualized quarterly basis the second quarter recorded growth of roughly 1.6% year-on-year, a softer read than some flash estimates but nonetheless a positive expansion driven by broad contributions from industry, services, and public administration. Output gains in Q2 were supported by continued strength in exports of goods and services, notably pharmaceuticals, machinery and foodstuffs, where 2024 registered robust export growth that fed into higher industrial throughput in the first half of 2025. Investment also contributed as gross fixed capital formation rose modestly, with public and private projects in energy, logistics and digital infrastructure lifting capacity. On labor markets, Denmark sustained exceptionally low joblessness. The unemployment rate sat near the mid-2% range in June, reflecting tight labor market conditions and healthy job creation, and long-term unemployment remained very low, signaling that firms broadly found it profitable to expand payrolls rather than hoard labor. Employment increased in Q2 with headcounts in public administration and health rising alongside private sector hiring in manufacturing and trade, while part-time employment levels illustrated flexible labor supply that helped maintain low headline unemployment without generating acute wage pressures across the whole economy. Monetary policy in Q2 reflected Denmark's customary focus on currency stability alongside domestic objectives. The central bank trimmed its key rate as the European environment turned less hawkish, lowering benchmark rates by 25 basis points earlier in the year and keeping certificates of deposit and lending rates around a moderate stance to preserve the krone-euro peg while softening credit conditions. This tactical easing provided firms with somewhat cheaper funding relative to the prior tightening cycle and improved transmission to bank lending rates, though policy remained calibrated to avoid rekindling inflation. Inflation dynamics were favorable for the productive narrative. Headline inflation moderated into the low single digits by mid-year as energy prices stabilized and global supply chain pressures eased, with core inflation also showing a downtrend that indicated limited second-round effects. This contained price volatility, enhanced household purchasing power, and supported real income growth, enabling private consumption to contribute positively to Q2 GDP without stoking persistent inflationary pressures. Fiscal metrics complemented macro stability. Denmark entered Q2 with a government debt-to-GDP ratio well below the euro area average, at roughly the low 30% level, leaving ample fiscal headroom relative to peers and allowing authorities to prioritize investment and targeted spending rather than aggressive consolidation. The relatively modest debt burden underpinned market confidence and permitted measured public investment in defense, green transition programs and transport infrastructure, which in turn supported near-term demand and longer-run productive capacity. Sectoral performance in the quarter underlined the productive tilt. Manufacturing output accelerated modestly as export orders and industrial output climbed. Agriculture and food processing delivered steady seasonal gains, and services, especially business services, logistics, and ICT, showed resilience driven by recovering European demand and strong domestic digital adoption. Construction recorded a mixed performance. While residential activity remained soft relative to the boom years, public and commercial construction projects associated with energy and transport upgrades provided counter-cyclical lift. External balance dynamics were constructive. The trade and current account positions benefited from the export surge and contained import growth as domestic demand growth moderated, with tourism receipts recovering and remittances and capital flows adding further buffers to external financing. Banking and credit conditions evolved in line with policy and activity. Banks increased lending to productive enterprises while maintaining prudent underwriting standards, and deposit rates and short-term money market instruments adjusted to the central bank's policy moves, preserving liquidity without encouraging speculative credit booms. Household sentiment in Q2 was cautiously positive. Consumers reported improving and income prospects while remaining mindful of housing cost adjustments. This translated into steady consumption of services and durable goods rather than abrupt spikes. Risks to the productive Q2 narrative were present, but manageable. Dependence on a handful of large exporters and the multinational sector introduces volatility to headline GDP. trade tensions, or global demand slowdowns could weaken external demand, and higher defense or social spending commitments could pressure fiscal balances if not offset by revenue gains. Nonetheless, policy buffers, low debt, sound banking sector, a credible exchange rate regime mitigated these risks and allowed policymakers to act flexibly. In summary, the second quarter for Denmark combined positive output growth, an employment market operating near full capacity, modest and easing inflation, a pragmatic interest rate stance aligned with euro area moves, and a conservative public debt profile. Together, these elements supported a productive quarter in which growth was anchored by exports, investment, and services. Real incomes were protected by benign price trends, and fiscal and monetary policy retained room to maneuver should external conditions deteriorate. Looking ahead, sustaining productivity gains will depend on maintaining export competitiveness, advancing planned infrastructure projects, and ensuring that monetary and fiscal policy remain coordinated to support investment while keeping inflation firmly anchored. Denmark's economy in the second quarter showed a productive stance, characterized by steady output, very low unemployment, and contained inflation, composing a story of balanced expansion. Annualized quarterly GDP growth was roughly 1.6%, driven by continued strength in exports of goods and services, notably pharmaceuticals and machinery. Investment also contributed, with projects in energy and logistics lifting capacity. The labor market sustained exceptionally low unemployment near the mid-2% range. Meanwhile, inflation dynamics were favorable, moderating into the low single digits. This contained price volatility, enhanced household purchasing power, and supported real income growth. This environment allowed the central bank to trim its key rate by 25 basis points, preserving the krone-euro peg while softening credit conditions. Fiscal metrics also complemented macro stability, with a low government debt-to-GDP ratio leaving ample headroom for public investment. While risks like dependence on a handful of large exporters exist, they were mitigated by strong policy buffers. In summary, Denmark's Q2 was a productive quarter, with growth anchored by exports and investment, and policy retaining room to maneuver. Denmark's economy in Q2 showed a productive stance of balanced expansion, not overheated growth. This was characterized by steady output, very low unemployment, and contained inflation. Output gains were supported by continued strength in exports, notably pharmaceuticals and machinery, which fed into higher industrial throughput. Investment also contributed, with projects in energy and digital infrastructure lifting capacity. Favorable inflation dynamics enhanced household purchasing power. In response, the central bank pragmatically trimmed its key rate by 25 basis points, softening credit conditions while preserving the crucial krone-euro peg. Fiscal metrics complemented this stability. A low government debt-to-GDP ratio, well below the euro area average, provided ample headroom for measured public investment in the green transition and infrastructure. While risks like export dependence and global demand slowdowns are present, they are manageable. Significant policy buffers, including low debt and a credible exchange rate regime, mitigate these risks and allow for flexible policy responses. Denmark Economy 2025, Q2 productivity fuels growth. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.